hello, everybody. Good afternoon from Vancouver. My name is Brendan Yurik. I am the CEO and co-founder of ELEC Royalties. We are a royalty company, obviously employing the best business model I think we've come up with to date in mining. We are the only pure play royalty group that is focused on the entire suite of metals associated with electric vehicles. So, as Go pointed out, we're targeting lithium, manganese, copper, nickel, tin, graphite, cobalt, and vanadium. We've got a really, decade-long, 2 decades long roadway here where you see exponential growth across all these different commodities, primarily stemming from electric vehicles and batteries, but also renewable energy as well. And we put together a really good team, that includes former founders of, royalty companies that have gone on to sell, for $700 to $800 million. And so we've also built a, very large advisory group. Obviously, it's a pretty complex sector out there, dealing with this many commodities, dealing with a space that's growing so quickly. So we have a bunch of advisors that help us, kind of navigate those waters. The backdrop of this is really the demand side, initially. As you can see by these charts here, we're at day one. We barely got even started. The growth rates that we're talking about here over the next kind of 10, 20 years, I don't think you've seen anything like this in human history before, where you're going to impact so many different commodities all at once. And so, we're really excited. We think we're just getting in at the right time. And it should be a really good kind of, 10, 20 years here. It's funny, the world doesn't seem to agree on much these days. One thing they all do seem to agree on, though, however, is, let's push and go for, improving the climate, cutting down carbon emissions, and going electric, and really clean electricity generation. So, we got China's in on this. You have the United States, all these countries, even India, banning the sale of petrol cars by 2030. These are big movements by countries to help facilitate this. They haven't really seen. Biden just won, obviously, the U.S. presidency. He's looking at adding 500,000 public charging stations by 2030, clean electricity by 2035. So this really is a global phenomenon, and this really is something that's being mandated at all levels, whether it be from government, from corporations, and individuals who actually are investing, and pushing this forward. So if you look at it, here's what I talked about. So you really haven't seen a rise in demand across this many commodities all at once like this in human history. Where you're talking about anywhere from 1,000 to 4,000% growth, expected over basically the next decade. And what's really interesting about that, and I think one of the things that you've seen, maybe even Tesla get wrong or maybe overlook, is the development timeline on these projects. The average timeline from drill hole all the way through to production to take a project through, it's about 15 years on average, if everything goes well. And it usually doesn't. And so, trying to see a place where we can increase demand by 5, 10 times over the next decade in some of these commodities, we really think there's going to be a lot of higher prices for a lot of these metals. And we really think that there's going to be an opportunity to benefit from that as we move forward. If you look at this is just basically the demand growth rates. The first one was metal demand. Now, it's funny because there doesn't seem to be that many people that are actually looking out on this. We had to go through about 40 different research reports to pull this together. Typically people are worried about, or they like, nickel because they have a nickel project. So they're only focused on nickel, or they have a, lithium project. They're only focused on lithium. We really try to look at the whole space and kind of see, all the different metals, what the impact would be. And the very first thing that we did was really look at the supply side of this. And when you talk about a 10, 15-year development timeline on average, it becomes much easier to actually forecast out, what potential projects might meet that pipeline. And so that's kind of what we did as a starting place. And we feel like we have a pretty good handle on that. But the supply side is really weak. So you have really exponential growth on the demand side, outlook kind of 10, 20 years, and you have a really thin supply pipeline. And I think that's, unless you've been in the industry and there hasn't been a whole lot of money or people focused on this for the last 10 years, you might not necessarily pick up on that, but that is probably going to be, at least in terms of the impact on pricing, the bigger, elephant in the room. So how do we play this kind of, amazing opportunity? We see 10, 20 years growth across all these commodities, very thin supply pipeline. So you're going to see higher prices. How do we play this? Well, to me, it's really obvious. We got to be a royalty company. It's the best business model I think we've come up today with mining. It's been very successfully deployed by the likes of, Franco-Nevada, Wheaton Precious Metals, etc. Why is a royalty company so great? Look, I like to joke around that I could spend, the next 30 years building out a Rio Tinto, one of the most globally diversified producers on the planet in the mining sector. And they're going to trade at around 7 or 8 times cash flow, whereas royalty companies, they're trading around 20 to 25 times cash flow. So you're talking, the exact same cash flow, but you're talking about 3 times the valuation. You still get leveraged commodity prices. You still get exploration upside, production rate upside, but you don't have to put any money up for capital cost overruns. It costs you nothing to hold the royalties. And you're not on the hook for exploration costs. Groups are moving these projects along as you hold royalties on them, at their own expense, at their own dilution, whereas we don't have to. If you look at average revenue per employee, you don't have to have a big team, which is really nice. I think the average revenue per employee, say one of the biggest mining companies is around 300,000 a year, or 300,000 per employee, sorry. And if you look at, say, Franco-Nevada, it's about 20 million per employee, right? So, you don't really have to build out a big team, but you can grow quickly. So we really like the royalty business model. The other thing about it is we actually try to, in most cases, tie the royalty to the project. So, even if management goes out there and, takes on debt at the wrong time, as it happens, or, finds himself in a situation whereby they lose the project, our royalty actually sticks to the project, and the next group that comes in would have to honor that. So you got a little bit of, security. And really the kind of main point about royalty companies is really diversification, right? I think that the traditional mining investment model of single asset junior mining companies moving along a single project is a pretty tough proposition, because it's a 15-year timeline to move along. There's 50 things that could go wrong along the way that you need to kind of knock off. Whereas us as a royalty company, we're diversified across commodities, we're diversified across assets. So much less risk and kind of gives you better exposure overall. Now, where do we go get these royalties? It's crazy to think, because the electric vehicles and renewable energy are, essentially replacing some very big energy sectors here over the next 10, 20 years. In oil and gas, let's use that as an example. For every $100 that goes into oil and gas, over the past 10 years, you might see, $10, $20 that would go into the mining sector. And for every dollar that goes into the mining sector, so let's say it's $20, you might see $1 have flowed through to the battery metal space. And so there's been a severe lack of capital flowing to the sector. There's lots of opportunities to create new royalties. There's companies that, across the commodity spectrum that we target, are very hard up for cash. And so we can basically go in and offer them financing. We might come in as a cost overrun financing. We might come in, even on acquisitions or, moving stuff along. But, feasibility stage, it costs a lot of money to get a project to feasibility stage. And all these companies have, depleted share prices. So dilution is a big factor to them, and royalties are a non-dilutive financing. So there's a lot of opportunity to create new royalties. And there's also a lot of opportunity to consolidate existing royalties. There's a lot of private holders out there that have royalties that, may be looking to monetize them ahead. Production may be 3, 4, 5 years out. And sometimes people just can't wait that long. There's also a lot of these held as non-core assets and other junior mining companies that, would love to have it, monetize it through a vehicle that's focused on this, because you always get a better valuation. Now, if you move ahead, so we just went public in July, but we've got a portfolio of 11 royalties already. Primarily targeting safe jurisdictions, Canada, North America, really, Australia, Europe, as the next projects that are going to be the supply for the EV space and the battery space, domestically. I think if you look at Tesla, Elon Musk has come out and he said, we're looking for domestic, source of supply. And really the reasoning is simple, because, if you're going to, the whole goal is to reduce carbon emissions, and you want to have a plant in Nevada, it makes sense to source your lithium in Nevada or in North America versus, shipping it, which also causes greenhouse gases. So, we're really trying to target the best projects in each of these kind of key jurisdictions. Like I said, we've already got 11 royalties. We're looking for long life assets. So something that an offtake group, a battery manufacturer, these guys want, some security of supply. So, something that has 20 to 40 plus years of mine life is always something we target. And we're looking for advanced assets. We're looking for the assets that are going to make it into production in this cycle, right? So if you look at a 15-year development timeline, it's kind of, PEA and above is really where we're targeting. So at least have economics around it. Some of them are construction ready, as I'll talk to in a minute. As we go through our portfolio here in a second, you can look at these kind of key demand drivers, right? And so it's really a trifecta. It's not just electric vehicles. It's not just batteries. It's not just carbon capture. It's really all of them hitting all of these different commodities at once. It is electric vehicles, that's renewable energy, and it's batteries. And each one of these commodities is pretty critical to that revolution happening. I think the biggest risk right now of people's hopes and dreams around the electric revolution, as we like to call it, really is going to be this securing these supplies and securing the metal supply that you need to make it happen. And we're just kind of starting to get into it. I think people are starting to pay a lot more attention now. So it should be a really exciting year as we kind of push ahead here. So this is one of our first royalties. This is the Oche lithium royalty. It's in Quebec. It's a gross revenue royalty. Gross revenue royalties are fantastic. They're basically, right off the top. So you can do annual production expected times metal price times the percentage of your royalty. And that's basically what you can expect in terms of annual royalty cash flow to come back. These guys already have a feasibility study. They're well advanced on permitting, expecting to get some news out this year on approvals. And they actually just had a strategic investment from Piedmont Lithium down in the States, which is the only group that's really got an offtake contract with Tesla. As part of that strategic investment, they actually also signed an offtake agreement with Sayona Mining, the operator of the royalty. And they're actually in the process right now of acquiring the Canada lithium mine, which is right next door. And so if that happens, I mean, we could be looking at cash flow from this, 12 to 18 months out. And that's kind of another nice thing, right? I mean, even if you are an equity holder in a junior mining public company, it's not like you're getting access directly to any cash flows. We do, and that allows us then, sometime in the near future, as most royalty companies do, we'll start paying a dividend as these cash flows start to come in. As part of this, we've also got a couple exploration royalties in and around the area. The Canada lithium mine is one of the only lithium mines to come into production in North America. And, it's usually, it sounds stupid, but it's usually right. The best place to look for, a mineral or metal is in and around a mine. And so we took a little bit of a strategic, kind of look at that. And, we're excited to be, in hard rock lithium in Canada. I do think there's going to be a, kind of a central hub there in Quebec and potentially in Ontario as well. But yeah, we're really excited about this royalty, and there should be some good news coming out on there in the near future. This is the Mont Sorcier Vanadium royalty. Very good project, put out a PEA this year. I think it's about a 33% IRR. Huge project, 1.7 billion NPV, 37-year mine life as it is today. This project, it's vanadium, titanium, iron ore deposit. Now these are, in theory, always look great if you can capture the minerals. The issue is typically the titanium content. Now these guys have a really low titanium content, which means the vanadium can actually be processed quite easily, and you can actually capture that value. So, that makes this project probably one of the best iron ore projects that I've seen in quite a while. And I do think that this thing will move ahead, quite quickly. Again, it's got access to infrastructure. It's already got a 37-year mine life. And, I think that's mostly a result of, if you got 37 years, why go spend a couple $1 million to drill it out further? But I do expect this to be, kind of a cornerstone asset for a long time to come. Moving on, this would be our kind of flagship manganese royalty, Battery Hill. It's really the only district. Manganese is kind of funny. There's only a few developers out there in the manganese space that are trying to produce manganese for the end users in the battery sector. These guys really have the only district that I've seen in North America that I think could work. They're very far advanced on metallurgy, despite where their current status is in terms of they're planning to put a PA out here shortly. But the metallurgy, I believe, is much more advanced than that. They've been working with Cometco here in Canada, and that's really the toughest challenge for a lot of these projects is the metallurgy, often overlooked and really a big risk when you're talking about. You need to get to 99.9% purity in some cases. It's a big leap to go from 95 to 99 to make that grade. And these guys have had some fantastic results. Ultimately this, when in production, will be the largest royalty we have. It's a 2% gross revenue royalty. And I do think that I joke around, but if Tesla wants to have a domestic supply in North America for their plant, they really have one option. So, this is a royalty that we're very excited about, and we look forward to that PEA coming out here in the near future.
Hi, Brandon. Feel free to wrap up if you want to answer some questions.
Yeah, sure. I'll mention this one quickly, and then we can kind of get to some questions. This is our graphite royalty. It's feasibility stage, basically construction ready. If you look at its peers, I think it's undervalued for sure, but you're talking about 100 million capex, 70 years of resources, long life, open pit, low strip ratio. I mean, it's a fantastic graphite project. It's got very high jumbo flake, and this is something that could be in production tomorrow, and kind of needs to be if these EV users want to make their timeline. So I understand there's a little bit of a time crunch, so I'll maybe defer to Gilbert and see if there's any questions that anybody has to ask.
For sure. So first question coming from Anya here on the Chinese side. She'd like to know usually what are the metrics for the investors should use to how to evaluate a company like yours?
Yeah, so I'd say we're ridiculously undervalued at this point in time. I kind of did my own metrics. I mean, I think we could be should be a $50-60 million company where we are today. You can value royalty companies a few different ways. One is off cash flow. We do not have cash flow at this moment in time yet. But like I said, the precious metals guys are basically trading around 20 to 25 times. In the critical metal space, I think you're going to start to see that trend higher. But right now it's about 10 times on cash flow. And so if you can run the numbers pretty easily on some of the stuff that I gave you and see where we're expecting cash flow to come and what that would be. The other way is based off of an NPV basis. And that's kind of how I arrived at my number. And so, typically be around, 2.5 times if you're a precious metals group. In our sector, it typically is right now around 1 times NPV. So the NPV of the royalty cash flows you expect from all these different projects.
Okay, this question coming from Duke. Is this quite competitive to look for deals right now that's suitable for your business model?
You know what? It's one of the nice things that we are the only group focused on this sector exclusively from the royalty standpoint. The precious metals guys, it's very competitive, highly competitive. I think we're the only group that's actually made a bid on some of these metals before in the royalty space. And so, at least at the moment, we don't have much competition for deals. We do on some of the commodities, copper, nickel, but we pretty much have free reign across the board on the rest of them. So it's an exciting time.
Sure. Just one last question here. Who are the key people in terms of looking at the technical aspect of the projects that you're financing?
Yeah, so I have a partnership with a group here in Vancouver. They're called the Hunter Dickinson Group. They've got one of the longest standing mining houses in Vancouver. And so they have highly specialized people that I can call upon on an as needed basis, and there's a lot of different, technical aspects of a mine. And so it's nice to have access to those people when as if I need them. But they've been around since 1988. Like I said, I think they're the longest and still biggest standing mining house here in Vancouver. And then we have a number of different advisors. Our advisors include people that worked at Yamana Gold, worked at Kinross, and we're talking about senior positions at a lot of these places. So we've built up quite a big team here to help navigate a tricky sector, like I said.
Thank you, Brandon, for addressing all the questions here today.
No, thank you, Gilbert. Thanks for having me on, and I look forward to staying in touch.